Skylar, we've seen the 10-year, good morning, seen the 10-year push through that 4% level. We're at 3.97% right now. Shutdowns can be good for treasuries. What are we expecting to see? What are you watching for next when it comes to treasury markets?
Yeah, absolutely. So what you've seen over the past few months is the rally in treasuries has largely been because you've priced in more Fed easing. I think also it's very true that the U.S. government bond market has returned as the safe haven of choice. From here, though, I think there's still room to rally. And the reason I say that is if you think about your 10-year, it's essentially just what you expect from Fed funds over the next 10 years, plus some kind of term premium. Now, the market expects we're going to cut twice this year and then get to a 3% terminal rate. If you compound those forwards and add a 60 basis point premium, that gets you to a 3.7% 10-year. So there is still room.
OK. But we're also doing this in a vacuum at the moment. No data, kind of, we're slightly, therefore, searching around for clues as to what is going on. Maybe we'll get some from the earnings story, but we're going to get some definitely on Friday. Are we just waiting for the CPI number?
It does very much feel like that. What I will say is generally market reactions to shutdowns is that it's very muted. And the reason behind that is that there's not usually a huge economic impact. So, yes, people don't get paid, but they get back pay eventually. So it's an issue around consumption timing. The one thing that differs there slightly is you do get a bid for treasuries because it's some kind of insurance as risks are tilted firmly to the downside. Now, I think the longer the shutdown goes on, the more you have risks to growth because if you think about COVID, if you go 2 months without having a haircut, you don't then go, I need 2 haircuts now that things are returning to normal. There's also a confidence issue. You also have spillovers into contract workers. And those contract workers don't get back pay. And the longest shutdown we've had has been 35 days, and it was a partial shutdown. We're going into week 4, and this is a full shutdown. So I think certainly risks to growth are tilted to the downside, and so then risks to bonds are tilted to the upside from that. But as you say, inflation data is on Friday, and that valuation I was talking about is based off of the Fed funds path. So if you have a sharply higher Fed funds path, then it becomes much harder to justify a rally.
Well, Skylar, just give us kind of maybe a floor in what that looks like when it comes to yields, because we have had guests on this program as recently as yesterday talking to us about the risk of a 10-year going to 4.7, 4.8. We're at 3.97 right now on the 10-year. Give us a floor.
Yeah, I mean, I'm not sure there really is a floor. It very much depends on how economic data evolves and inflation. Personally, I'm very worried about inflation in the U.S. because we're not getting the data coming in. You haven't had it reflected in markets. But I think because you have tariff level inflation, you have immigration pressure inflation, you're seeing inflationary pressures that are just delayed rather than avoided altogether. So I think certainly the floor is maybe higher than what the market assesses on that 10-year.
Certainly something we're going to keep a very, very close eye on, and whether or not you see a very quick bounce back. Bloomberg MLIV, Skylar, Montgomery, Koning joining us this morning. You get more up-to-date analysis from her and the team. MLIV Go is the function on your Bloomberg terminals.